What I'm really saying is that the odds of the S&P being at current levels by the year end, I think, are low. In other words, I think that it's going to be. I think the market's going to be lower by the year end. My view is that the assets that are very much out of favor now are the ones that are going to come back into favor.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a very special discussion with Mr. Liquidity himself, Michael Howell, founder and CEO of Crossborder Capital, which is now rebranded as Global Liquidity Index. Michael, thanks so much for joining us today.
Well, great pleasure to be here, Adam. Happy New Year to everybody. Let's hope it's a good one, but I fear there's challenges ahead.
All right. All right. Well, we'll pick up on that thread immediately. Challenges ahead. Very quickly. Happy New Year to you. Hope you're staying warm. I see you've got a nice turtleneck on, so hopefully it's not too cold in the UK right now.
Yeah, well, it's pretty cold. It's about -5, which is pretty cold for the UK.
Oh,
There's
yeah.
snow everywhere, so there we are.
Okay. Well, all right. Well, hopefully we can generate enough heat with this discussion that we can warm you up. All right. So we're going to get to your latest slides that you kindly prepared for us in just a second, Michael. But as I recall, you have your global liquidity cycles that your firm has identified. And in our previous conversations over the past couple of years, if I remember correctly, you had forecasted the current cycle to kind of peak out at the end of 2025, beginning of 2026. Is that still your expectation, or have there been any developments like the Fed kind of returning to QE, even though they're not calling it QE, that might be pushing the duration of the cycle out further?
Yeah, all the evidence seems to show that the liquidity cycle is peaking pretty much around the time we said. I mean, we're still getting data coming in for the end of the year, obviously, but it looks as if the peak in liquidity probably occurred sometime around about Q4, maybe early Q4 or thereabouts. And that's, despite the fact the Federal Reserve, as you said, has kind of moved back to a more benign liquidity posture. They were kind of forced to do that because of the tensions in repo markets. But what the Fed is really doing is basically, doing the sort of minimum necessary, I would say. They're sort of putting a put under the repo markets, and that's probably enough to keep tensions away there. But it's not really enough to keep the bull market in stocks going through the year. And I think the monetary policy the Fed is operating is probably at best good enough for a range-bound market this year. It may not be even enough for that, but we'll see. So, our view is that the year is going to be challenging. Liquidity is not the force that it was. Certainly, if you look at the major advanced economies, I think China may be a different story, which we can get into. And, one of the things that we're bringing out very clearly this year is that there is a significant divergence between what's going on in the US liquidity cycle and in the Chinese liquidity cycle. But that's a later story, I think.
Okay. Well, I look forward to getting into all of that. I just had a conversation yesterday that I'd love to get your thoughts on, and it's about the guidance that U.S. Treasury Secretary Scott Bessent has been giving in terms of the criteria of what the administration is looking for in the next Fed head. And Scott Bessent is kind of leading that search. And he's essentially said, we want a Fed that is quick to respond to issues, but one that doesn't give too much persisting stimulus. And he cited, things like the Fed buying mortgage-backed securities for years after they probably should have stopped, and housing prices were, zooming to new highs and things like that. Do you take that into consideration at all in your forecasting?
100%. I think it's a key point, and I think Scott Bessent's been very clear. The Federal Reserve has sort of been operating an unguided hose. It's basically pushed liquidity out, lots of liquidity out to many pockets, not just in the US economy and US markets, but worldwide. And that really has come at a cost of what you may call the K-shaped economy. And I think that's what he wants to get away from. And therefore, what we've been arguing over the last 12 months is there's a very distinct shift away from what we can term Fed QE towards Treasury QE. Now, Treasury QE is more subtle, but it basically is saying that liquidity is being injected directly into the real economy rather than willy-nilly into financial markets. It's directed, it's going into things like government procurement, defense spend, critical minerals, these sorts of areas. And it's been funded at the front end of the curve through the bill market. And that has an effect on liquidity, but it's creating liquidity, but it's creating liquidity which is being used in the real economy, not in financial markets. And although the Federal Reserve, in our view, is unlikely to be tightening through this year, it may conceivably ease. I mean, I doubt that, but it's possible. The fact is that a strong real economy is going to absorb a lot of liquidity out of financial markets. And the more one looks around the world, the more evidence there is that fiscal policies are stimulatory, that real economies are starting to pick up. After what has been probably 2 years of monetary stimulus generally, it's about time they did, and they're beginning to get some traction. And that by itself will actually absorb a lot of the liquidity that's washing in financial markets. And therefore, even without central bank tightening, the liquidity cycle is going to start to dip down. And that really is the main factor driving our view of the markets.
Okay, so it sounds like what you're saying is that the administration, at least here in the US, may kind of start making good on their promise that it's Main Street's time over Wall Street. Because what I sort of hear you saying, and tell me if this is too simplistic, is the liquidity environment is shifting now to basically, instead of assets over paychecks, it's now going to paychecks over assets.
100% true. That's the way we see it. Yeah, it's Main Street's term. Scott Bessner has been very clear about that. He keeps saying that, keeps reiterating that, and that's the way that we see it. The U.S. economy, in our view, is going to be pretty decent next year or this year. I apologize, this year, and it's being driven by strong capex, particularly in AI, and persistent government spending. The consumer, may be slightly sort of on the back foot, but generally speaking, two major engines of the U.S. economy look pretty robust.
Okay, and so we can pull up your slides here if you like, Michael. But I think it's important to remind people, and you can opine on this any way you like, that the economy and the stock market, while we tend to think of them as being really tightly correlated, they are two different things. And you can have a year with a strong economy, but a underperforming stock market. And it sort of sounds like you think that actually might be the tenor of this year.
I think it's very much the tenor of this year, Adam. Strong economies don't always have strong financial markets, and that's really the key observation. And I think if we sort of go through some of these slides, maybe start with this one. This is looking at the average gain in the S&P each year of a presidential term. In other words, taking 2025 as year one, year two is 2026, etc. So this is the average performance in each of the 4 years of a presidential term since 1970. Now, what you can see there is that year one is pretty decent. Years 3 and 4 are pretty decent, but year two, not so good. And there's a very clear dip. Now, we get a lot of pushback by disoffering this observation. And clearly it's not set in stone, but it's something that one has to ponder and take into account. We get a lot of pushback because people say, well, look, the economy is going to be really strong. You've got strong earnings. That's going to mean the stock market keeps going up, etc. But then just take a look at that. That's the corresponding slide for earnings per share growth on the S&P index companies each year in a presidential term. So it's not unusual that the second year is a very strong year. In fact, the strongest year for earnings out of the 4, and still the stock market goes down. So what you typically see in year 2 of a presidential term, this is clearly we're playing with averages here, is you get PE multiple compression. And that's one of the things that we're concerned about, because what's driving that is liquidity conditions are likely tightening. And it's not necessarily because the Federal Reserve is tightening. It's much more about the real economy as absorbing liquidity from financial markets. All liquidity that's anywhere must be somewhere. And if it's not in financial markets, it's in the real economy and vice versa. And that's what we're principally saying. So this is the concern we've generally got. And I think if you sort of, plow on and take a look at this slide, which, I took the pink press cutting from Twitter. I can't quite read the source, but it looks given the fact that it's pink, it probably came from the Financial Times in
Financial
London.
Times. Yeah.
But what that shows is a series of bubbles, and you can pretty much make them out going all the way back to the mid 1970s. The red line that you can see put on top, overlaid on top, is our liquidity cycle, our global liquidity cycle. And what that principally says is that almost every bubble that you can see there has been inflated by some prior pickup in liquidity conditions. Now, if liquidity conditions are inflecting, then we may have a problem. And that's pretty much as we see it. We think that there's an inflection going on, and therefore a lot of these gains that we've seen are likely to stop or potentially reverse in some cases. And what I can do is maybe demonstrate. This is showing the track of global liquidity. This is weekly data, and it basically goes back or starts in 2022. And you can see on the left-hand scale that that is measured in trillions of dollars. So we're sort of touching around $185 trillion of global liquidity. The thin line on there is an estimate that we basically put together very quickly, which comes out within a few days after the end of each week. And it's what we call our flash estimate. It's not a full sample estimate. It's a best guess with the data we get. And I've just put that on the same chart to kind of show that the full data, when it comes out, is the solid line. The flash estimate is what we basically report very quickly to our clients, but it pretty much tracks the same thing. And what you can see is that liquidity conditions are flatlining. There may be a little bit of a sort of flicker up in the latest week or so, but generally speaking, it's plateauing. It's not falling yet. There's no question about that, but it does seem to have lost its upward momentum. And that clearly is something of concern. So that's one of the factors that we put into account when we make an assessment of what the market's doing. Liquidity conditions, which are a major driver, are looking as if they're beginning to slow down. And all our work on global liquidity, particularly the global liquidity cycle, is measuring the momentum of this aggregate, this global liquidity total. Now, the other thing to take into account is how liquidity sits relative to asset markets. And one of the best gauges of whether we're in a bubble or not and what the risks are, particularly in equities, is to look at the ratio, as we show here, between all equity holdings worldwide and that pool of global liquidity. So what you can see is the data going all the way back to 1980. I've tried to make sense of different periods of that, where you see, for example, in the first maybe 15 years of the chart, a period of financialization when, following the sort of the high inflation era of the 1970s, investors moved back into financial assets, and demographics were clearly leaning behind them as well, and that was helping to push more and more people into equities and risk assets. Then you see a sort of period of speculation around Y2K and taking into account the GFC in 2008, 2009. And then you see a period which is more of a flatlining, which I think is very well explained by Mike Green, who's talked about sort of passive accumulation and the fact that asset allocation is maybe not what it used to be. In other words, there are not the big swings now. A lot of money is basically is going into asset classes in fairly fixed or regimented amounts. And you can see that what we're doing right now is breaking out of that channel into a somewhat higher level of, if you like, equity holdings to liquidity. And that's getting back to previous periods of sort of speculation that we saw back in 2000 or 2008. And, that's clearly worrying by itself. The other thing that one needs to take into account is the risk behavior of investors. Now, what I've shown on this slide, which is actually very similar data, is to actually put this together in terms of a portfolio to say how are portfolio allocations being expressed. And this chart is a measure. It's actually a z-score underlying the numbers here. But what it's showing is how much people are skewing their portfolios towards risk assets. And that's if you move up to a higher positive number, or they're skewing the portfolio towards safer assets like government bonds. Risk assets are things like equities, corporate debt, emerging markets, etc. Whereas safe assets are cash or G10 government bonds. And that's pretty much what you see here, is we're seeing this cycle of risk appetite, if you like, or risk exposure, which looks to me as if it's beginning to go down. So in other words, investors are becoming a lot less risk seeking maybe than they were. So if you've got two parts of a pair of scissors, two blades, which are now starting to move pretty much in the same direction, liquidity going down and risk exposure going down, the backdrop for financial markets is going to be problematic, to say the least. And that's pretty much how we see the coming year.
Okay, and when you say problematic, what is your forecasting telling you? Does that mean more volatile? Does that mean more flat? Or does that mean, prepare for some sort of substantial correction?
Well, I think that I always push back against the volatility idea, because I always think volatility is a bit of a cop out, because you can be right and wrong at the same time with
Right.
volatility.
Yeah.
What I'm really saying is that the odds of the S&P being at current levels by the year end, I think, are low. In other words, I think I think the market's going to be lower by the year end. My view is that the assets that are very much out of favor now are the ones that are going to come back into favor, like government bonds and maybe the US dollar. That's very much a contrarian view, but that would be pretty consistent with what we're seeing in terms of the late cycle flavor of what we're detecting here in terms of the data. Now, bear in mind, we're not looking here at economic indicators. We're looking purely at liquidity flow, and we're looking at how investors are positioning their portfolios in terms of asset markets. And it's those factors which are telling us that it's late cycle. But then I'd have to say that if you look back over the last few years, those have actually been pretty good handles on prediction. The real economy has not been a particularly great guide to asset allocation over the last couple of decades.
Okay. So, well, you mentioned here that you actually think the peak might be behind us now. I mean, I'll give you a little more time just in case the data bounces around here. But if indeed we have peaked in Q4 of 2025, what is your projected or expected length of the down cycle?
Well, it's an interesting question. I mean, the fact is that if you look at this chart is identifying the cycles. This is for the advanced economies, I should stress. It takes China out. The reason for taking China out is that China is, or certainly lately, has been highly volatile, and it's distorted the picture. This is the major advanced economies worldwide, ex-China. And what you can see is that the cycle length has been a pretty standard 65 months over that long period going back to the mid 60s. We think that that is all to do with a debt refinancing cycle, that financial markets are very much about refinancing debt, rolling over existing debts. They're not about raising new capital for new greenfield projects, which is what textbooks tell us. Those days have long gone. It's all about rolling over debt. And the refi cycle is basically a 5 to 6 year cycle that repeats. And we seem to be peaking out now in terms of that cycle. Now, if it's true to form, I mean, you're looking at a downswing, which could easily be lasting. I mean, clearly these things vary, but on average, you could be looking at something like a 35-month or 35-month downswing. I mean, that's entirely possible. You can see historically that some of those downswings have been rather sudden, and therefore it may be over quickly, but that will be a short, sharp shock. And all I'm saying is that we've got to be cognizant to these risks. Nothing is certain in liquidity nor in life, as we know. And it may well be that the current sort of sawtooth picture we're seeing at the peak is something which is going to persist for several months. So it may be that you get a blip up in the next month and blip down the following month. It's quite possible because you can see that pattern historically. But it does seem as if we're seeing this inflection pretty much about when it was originally, if you like, envisioned, which is late 2025. Everything seems to be lining up. Now, the other thing that I think is worth stressing is that if you look at the average length of the cycle, we seem to be fulfilling that criteria more or less exactly.
Yeah.
So this is looking at the average cycle length since 1970 as the dotted line, and the latest cycle is sort of put on in context. So it looks, more or less as if we're moving down the same track. And then how do we express this in terms of asset allocation? Well, this diagram is the one that we use, and what this illustrates is on the left-hand side of the diagram, we depict various phases of the cycle into sort of generic names to give some flavor, like calm, speculation, turbulence, rebound. And then on the right-hand side of the diagram, we then try and associate that with asset performance. And that's done through experience and data and looking at how markets have performed historically. But what you can say from this is that typically the upswing of the liquidity cycle is a risk-on phase. It tends to be that you favor equity markets first of all, particularly during the long up wave. Commodity markets tend to do well about the peak. In the downswing, you want to be holding more cash. And then by the time you get to the trough of the cycle, you really want to be loading up heavily with government bonds, longer duration bonds, and then the cycle will restart again and you'll go back to a risk-on environment. Now, if you look at this particular cycle and you look at the evolution, and we can go on to that in a moment, basically what it's telling us is isn't this exactly how markets have performed over the last 3 or 4 years?
Yeah.
It's not been about economies at all. It's been about a fairly standard liquidity asset allocation cycle. And this following chart embroiders that a little bit more by looking at different types of equities, whether it be cyclical value, cyclical growth, defensive value, defensive growth, and then looking at different phases of the yield curve, which we can come on to in a few moments. And that particular articulation seems to be unfolding almost exactly. Now, this reference slide here is looking at business cycles. And what I've done is to look at various measures. One is a straightforward average of all world business confidence surveys, which is the orange line, the solid orange line, which is labeled world business cycle. So that's things like the US ISM, the Purchasing Managers Index. It's things like the Tankan in Japan. It's things like the IFO survey in Germany, the CPI survey in Britain, etc. And those are weighted by GDP and put together as that orange line. The dotted line is the JP Morgan S&P World PMI Index that they independently create. Mm-hmm. And the black line is an AI projection, which is using is an algorithm that basically looks at things like commodity prices, currencies of trade-sensitive economies, credit spreads, etc. And that infers from that data what the economic tempo is. On all three of those measures, which pretty much seem to concur, what we've had is a flatlining at best in economies since the end of COVID. Okay, there's been no cycle, but still you've had a very pronounced cycle in terms of asset markets and financial liquidity. And that has been, that has occurred despite flatlining economies. And you've had a very normal progression. And this traffic light diagram pretty much confirms that by saying that if you run through those traffic lights, assets are on the left, industry groups are on the right. What it's telling us is that, you in the rebound area, you want to take a little bit of risk. I mean, take these as traffic lights. So amber means proceed forward with caution. Green is go, red is stop. You wanted in that rebound to have a little bit of positive exposure to markets. You wanted full on equities, full on credits, no commodities, no bond duration. As you moved to calm, you wanted more equities, a little bit less credits, certainly more commodities, no bond duration. Speculation, where I would say the US market is now, you want to be getting a little bit more cautious on equities. You still want commodities. You're going to put a toe in the water in terms of the bond markets. Europe and emerging Asia, we think, are in the late calm stage of markets. US is more advanced in speculation. And it may well be that China, which we're going to come on to in a moment, is probably in a much earlier phase, potentially in the rebound area. But that's another question. If you look at the industry groups, Interestingly, what that says in rebound, you want full on technology. You maybe want a little bit of financials. By calm, you want full on technology, full on financials, full on commodities. By speculation, you want to be you want to be out of technology. You want to be, neutral to slightly positive financials, but still full on energy commodities. We told our clients to move to energy recently, but fortuitously maybe without predicting the Venezuela situation. But I mean, generally, you would expect to see energy beginning to perform at this stage of the cycle, and then you start to get more evidence of defensive groups beginning to perform. So it looks as if as they say, if it's yellow and quacks, it's a duck. And it looks as if this is sort of at the moment still quacking. So let's listen. So that's the asset allocation backdrop.
Yeah, these asset charts that you have I just find them so helpful. They're such a great service. So a couple of things. One, I guess I should say, Michael, you've been kind enough as usual to send me the slides. Folks, as usual, the slides will be made available to our premium Substack users. So you can just go to thoughtfulmoney.com/Substack if you don't already subscribe to it, and subscribe to it there. Michael, could you go back just very quickly to the asset cycle chart that you had? Yeah. So commodities have really caught fire in the past 6 months. And I'm trying to get a sense for where are we between speculation and turbulence here? How close are we to the black line there, where you switch from speculation and go into risk off on turbulence? Kind of what I'm asking is for those folks that are in commodities right now, how much time do they have to still be long that space before they need to start to lighten up?
Oh, I think that I think you can stick with commodities for some while yet. I mean, in our view, what's happening is the performance is moving away from financial assets more towards tangible assets.
Okay, so
And
out
therefore,
of
things
tech
like
into commodities.
yeah, I think that's the obvious trade for me. I mean, that's one we've been favoring for a few months now. But I think that that's something which is still going to run as far as I can see. And I think the commodity space has still got further to push forward. So I'm still optimistic on commodities, not least because we think the real economy is going to keep going.
Yeah.
So or certainly pick up, accelerate. So I think that's a fact. In terms of quickly on what does it mean for returns? I mean, if you look at the liquidity cycle, I mean, I'd stress at the moment, we don't see a negative print on liquidity, okay, as yet. This is our projection of global liquidity as the dotted line, the orange dotted line there, going into 2026. So we think there's a slowing down. We're not confident we're going to see a absolute drop yet, but that inflection may be important, and it may be putting a lot of pressure on financial assets. The black line is all wealth. It includes precious metals. It includes bonds. It includes equities, liquid assets. It includes residential real estate, etc. All these factors are thrown into that portfolio, but it shows how sensitive those asset classes are to changes in the tempo of global liquidity, which is what we show there. What's also sensitive are things like cryptocurrencies. I've shown this before, but this BES dollar symbol is actually Bitcoin, Ethereum, Solana in a 60, 30, 10% weighting. And this basically shows their movement versus global liquidity. They're very much a short-term indicator. And a lot of people use our data to try and manage their portfolios. But this is looking at the performance of that basket in orange. We look here at 6-week changes in that basket, and we show that against global liquidity, the dollar amount growth rate. But we've advanced global liquidity here by 3 months, 13 weeks, to show that it does predict forward that constellation.
Okay.
The other thing,
Sorry to interrupt, but that I would presume then your outlook for Bitcoin and the cryptocurrencies not super positive for the next couple of years.
yeah, I think that in my view about, I mean, all these monetary inflation hedges is that generally speaking, I think that they're good because what we've got is an environment where there is plainly monetary inflation going on in the world economy. This is the plain fact that's staring us, in the face. The governments need to spend money. They've basically taxed us out now. There's no, we're on the wrong side of the Laffer curve. There's not much more they can do that way. And bond issuance is kind of difficult. So they're going to have to print money. And that's monetary inflation. I think the question is, and the hard question is, does that come through to Main Street, or is that just an asset market phenomenon? And my view is probably a little bit of both. But I'm tending towards the view that Main Street inflation this year may be more subdued than people think for a variety of reasons. But generally speaking, monetary inflation over the medium term still maintains. So I'd still have these monetary inflation hedges in portfolios, but I think the fact is you don't want to chase them, and I'd be buying them more on weakness rather than trying to buy into momentum right now. The reason for that is that if you look at this chart here, which is an attempt to try and measure what I call true US inflation. And I think one of the difficulties is that there's a lot of distortion going on in the Treasury market, really because of the nature of funding in the US markets, and this big skew towards bill finance, which is actually part of this whole narrative of Treasury QE that I alluded to earlier on. And what the Treasury is doing is funding a lot of the deficit at the short end of the market. Now, that has pluses and minuses. The pluses are that it's probably cheaper. And if they get the right guy in the Fed, they can control that cost, obviously, by keeping rates low. The downside is that it's basically inflationary in the long term. And so we've got to be watchful of that. But generally speaking, in the short term, it has a distorting effect. And that distortion is shown in the orange or orange-yellow line, which is basically the implied break-even inflation rate that is evident from the fixed income markets. This is the straight measure that comes from the TIPS market, the Treasury Inflation Protected Security Market. And that shows kind of a flatlining and no inflation problem. The dotted line is a deeper dive into the data that basically says, well, okay, if the Treasury market is distorted, maybe other markets like the MBS market is less distorted. And if we try and get an equivalent gauge of inflation expectations from that, what is that showing? And that gives us a much more pronounced pickup at inflation over the previous 2 or 3 years, as you can see from that red dotted line. But even that's coming back. And then the other measure is looking at University of Michigan expected inflation, which is what consumers are telling surveyors what they think inflation is going to be. That clearly has been bumping around, and you can see the big spike over the last 12 months or so. That too is coming down. So it may well be that in the short term, the need for these hedges is not as great as maybe people are thinking. And if you look at this chart, this is another one maybe to sober people up a little bit. And this is really under the label "trees don't grow to the sky," and what it's showing is 5-year average US CPI inflation, which is the black line. Now, what we've done, to be clear here, is to get future 5-year inflation, we've extrapolated the latest rate of inflation forwards, so we get a 5-year figure. So there's obviously some bias there, and you may want to raise that black line a tad. But the point being is that it looks as if that's inflecting downwards. And you can see with the orange line, that's basically crypto, the universe of crypto and gold, in other words, monetary inflation hedges, relative to the pool of global liquidity. Now, what that's trying to say is that when you get a big pass-through of a liquidity surge into inflation, you want to buy monetary inflation hedges. And they perform strongly, as that chart says, particularly evident in the 1970s. And it's again been evident recently when they've surged. If you're getting an inflection in inflation, are they the best thing to hold? And that's really a question that we've got to start posing. And in my view, this is the thing to start thinking about seriously, which is a very counterintuitive thought, And this kind of goes against most of the consensus view, I think, on the street at the moment. Now, this is looking at global liquidity, and this is getting slightly wonkish in the weeds when we start to introduce concepts called term premia. Now, term premia are the way that if you're a fixed income analyst, you'd really analyze government debt. And this is looking at the premium that people or that investors demand to hold a fixed income security over and above expected interest rates. So it's the, if you like, the risk premium bit. Now, the interesting point is that that cycle in term premia, and this is the change in term premia, I should emphasize, matches almost exactly the global liquidity cycle. Okay, they're two completely different sets of variables. Global liquidity is a measure of flow, monetary flow. It's a rate of change indicator. Whereas if you look at that world term premium, it's simply a spread that we calculate from the term structure around the world. Now, what this basically is saying is that when liquidity turns down, term premia start to drop. Now, that's a really, really important fact. It's completely contrary to what central banks tell us. They tell us rather the opposite. But the fact is, the plain fact is that when you see declining liquidity, what you tend to find is falling term premium. And the reason for that is because in a lower liquidity environment, default risks in the system are heightened. And with heightened default risks, you want to take less credit risk, and you want to be holding more safe assets. And government debt, particularly longer dated government debt, is a very good hedge against those credit risk features. And so that's where investors tend to go. So as liquidity conditions drop, the risks of default or credit risk increase, and the demand for government bonds tends to increase. And that's why term premia are paired lower, as you can see here. Now, if term premia are coming down, what's going to happen to the bond market? And the interesting point to note, to associate, is here is the chart for the US, which is looking at the average yield curve slope. Now, the reason for doing this is slightly technical. Why don't I look at a 10-2 spread or a 10-1 spread or a 5-1 spread or whatever? The reason being is that different people have different preferences. And this is really a catch-all for saying, let's just look at the area under the yield curve, which is an average of all those spreads to be completely, unambiguous. And let's chart that against US liquidity. And what you can see is a very, very close relationship. And, back in the days, a long time ago now, that I was at Salomon Brothers, this is what we used to look at very closely to understand yield curve movements. And what it shows is during periods of expanding liquidity, what you find is the yield curve tends to steepen because term premia are going up. And when you start to see an inflection in liquidity, you get falling term premia and an inflection in the yield curve. And the lead time is about 9 months. So what this should be telling us, if this is true to form, is you should be getting some inflection in the yield curve around the middle of this year. And that is a completely non-consensual view. We get pushback and people say, well, of course, you've got a strong economy. Inflation expectations are going to pick up. The yield curve is going to keep steepening. The fact is that if you look at the data, the yield curve normally starts to inflect lower during a period of rising economic activity. In other words, you tend to find that the peak of the liquidity, the peak of the yield curve is not far away from the trough in the real economy traditionally. And that's maybe what we're seeing once again. So that would tend to suggest that you want to be thinking about bonds. And this chart, which I'm not going to go into now, is a statistical exercise that was done almost 10 years ago, which was saying that's the relationship between the yield curve and liquidity. It looks robust. It was estimated over that period, that long period. We've had at least 10 years out of sample now where exactly the same thing has happened. So it looks a pretty robust relationship. And therefore that's saying, here is the 10-year Treasury yield. Are you going to get the yield spiking dramatically higher? No, I just think it's probably range bound, and maybe bonds are not a bad bet in portfolios. I probably tend to lean towards the 5-year buying a 5-year bullet. But that would be, I think, a fairly prudent position to take in a portfolio with the uncertainty around this year.
Okay. Just to make sure I'm remembering your previous charts correctly, while bonds may start performing better later this year, that's probably going to be the path to get to that state is probably going to go through a point where you're going to want to hold cash because we're going to switch to a risk-off environment.
Yeah, I mean, what I'm saying is, I mean, a 5-year bullet, a 5-year bond is, pretty cash-like.
Right.
You haven't got much duration risk in that. You may want to go shorter term, but I think, the fact is that we can't predict who is going to be the next Fed chair, and it's entirely possible that the president decides to choose somebody who is going to cut rates more than the market currently thinks. I'd be surprised by that, but, never say never.
Right. Never say never. Okay. So 5-year right now. Now, potentially, you're back on this program in 9 months. Things go the way that your cycle predicts. At that point, you might start saying you might want to get some longer duration bonds.
Yeah, I think that's right. But I mean, there again, you've got to remember that, investment is all about anticipating what the world looks like in 9 months' time or so,
Yeah.
not what it looks like now.
Mm-hmm.
And then what we should be preparing for that period, buy things that are kind of out of favor right now. And that's what I'm saying. I mean, it's a non-consensus view. It's very contrarian, but this is the way that we see it. We may be completely wrong. Hands up. I mean, it's not the first time.
And I will say you're not alone out there, given the wide spectrum of folks I interview, but you definitely are in a minority with that call. But for all you presented all the reasons and logic why you believe that's the case. Um, just two assets I want to ask you about real quickly. So you showed the chart there of, I think it was the Bitcoin and precious metals index, which had been performing very well of late. But we're now having an inflection, as your chart showed, with inflation expectations. Gold's done great this year. Silver's done bonkers this year. You just said, your job's to anticipate, and you want to kind of buy the things that are out of favor in anticipation of them being in favor. What is your opinion right now on gold? Has it run so far, so fast that this is the time to start taking profits in anticipation of the next phase? Or do you think it has more room to run for, more structural reasons?
Well, I think it has more room to run for structural reasons, for sure, but I wouldn't be chasing it right now. And I think the same with silver. I mean, I'm optimistic about these metals in the medium term because I think we're in a world where we've got monetary inflation. I mean, my point, consistently is this is not about financial repression. I don't believe in a world of financial repression because government doesn't have agency to actually control things. I mean, if they could control interest rates and GDP growth, as people who advocate financial repression say, why don't they always do that? It would make common sense. What they do have agency over is monetary inflation. They can print money, and that's what they're doing. And they're going to have to do that because, as I said, we're on the wrong side of the Laffer curve for taxes, and bond markets can't absorb the degree of spending that governments envision. So we're going to have monetization. And that means you want these monetary inflation hedges in your portfolio, but don't chase them now when there's a lot of momentum in them. Start to wait till they cool off and then buy them on dips. And, as I've said to people in the Bitcoin space or even in gold, I mean, if you're buying these assets, when they're one standard deviation or so below their trends, that's some pretty decent investment strategy as far as I can see. I mean, that might mean you buy them 20%, 25, 30% below, trends, but that's what I'd be looking for.
Okay. All right. And that's where I was going to go. Like you'd said with Bitcoin, you're recommending folks buy that on weakness. Sounds like you're saying the same thing with the precious metals.
Yeah.
And then real quick, because they are included in some of your metrics of wealth here. Just curious how you expect housing to fare during a liquidity cycle downturn.
Well, I think the answer is that in the US, it may well be that housing is a different question, that we've got downward pressure on house prices. I think that seems to be the case. And that may well be something we observe over the next couple of years. I think if you start to look in Asia, particularly if you look at China, you may be seeing exactly the opposite. And what I can do if you want, I was going to talk about the risks to debt and liquidity on this slide, but what I can do is turn, if you like, to China and maybe try and bring China into this picture. And then
That was
if
my
there's
next
time,
question for you. So yeah, please.
let me do that and I'll come back to this chart. This is all about the US, what's happening in US financial markets. So let's begin with the China story and let's look at this slide. So this is looking at liquidity cycles. And what I've got here is the US cycle and the Chinese cycle. Now, both are calculated in exactly the same way. You can see the Chinese cycle is choppier, although it does seem to follow a sort of cyclical pattern to some extent. The reason it's choppier is that Chinese markets are not so well developed and you tend to get sort of lurches and it is much more difficult to fine tune these things. But you can sort of discern a cycle evolving. And it's fair to say that if you go further back in time, certainly before 2000, but it's also evident in the 2000 to 2005 period, there was much greater correlation between the US and the Chinese liquidity cycles. What you're looking at now is almost completely out of step movements. They're desynchronized. They're very much out of step. And that's an important consideration because it looks as if the US cycle is peaking and dropping, whereas the Chinese cycle may be bottoming. And so that bottoming out process is something that we need to consider because it may give us a further opportunity in Chinese stocks, which, you know, have had a pretty decent year. If I recall, they're up about 25, 26% over the last year. That's probably besting Wall Street, but, you know, it's not a bad place to be and it could continue. Now, the reason it could continue is explained in this chart. And what I may have to do is just to explain this chart by going back in the slide deck to actually an earlier one that I was going to show regarding more general or generic points about debt and liquidity. So just let me dip back and I'll come back to that chart. And what I need to do is to look at this chart. This chart is trying to put in context the problem or the cycle in financial markets worldwide. And what it looks at is a metric that we favor, which is the debt to liquidity ratio. Now, many economists, contrawise, look at debt to GDP. You know, I'm cynical enough to say, you know, they do that because they can. It's easy to do. Okay, debt and GDP can be measured, and so it's a nice ratio. But it doesn't tell us anything. All it does is trend from bottom left to top right. So what? You know, Japan is 400% or whatever it may be. The US is 200%. Does that tell us anything? No. What you need to look at is the debt liquidity ratio. Why? Because debt needs to be refinanced. It needs to be rolled over and you need balance sheet capacity. And therefore, if you look at this chart, it's first of all mean reverting. It's stable, if you like. It runs from, you know, left to right, flatlining pretty much, but there's a cycle. And what you see is periods where the debt liquidity ratio is extended. I've annotated where you get financial crises. And the reason you get financial crises is you get refinancing tensions in markets when there's insufficient liquidity to roll the debt over. Now, my claim is, rightly or wrongly, that every financial crisis that we've seen over the last 2 or 3 decades has first and foremost been a refinancing crisis. And therefore, you need to look at this relative ratio between debt and liquidity. If you go on the other side of the divide there, the dotted line, when there is too much liquidity relative to debt needs, you get asset bubbles. We've just come through the biggest one of those called the everything bubble. And that's because you had 2 things going on simultaneously. Number one, you had policymakers throwing huge amounts of liquidity into their markets after the GFC and after COVID. Every problem is addressed by more liquidity. I mean, even just take the latest episode with the Federal Reserve and the repo problems in the US. What have they done? More liquidity. And the other thing that happened is that interest rates were slashed to 0, which encouraged a lot of borrowers to term out their debt into the late 2000s. And what you're seeing is that debt liquidity ratio rising, A, because liquidity is slowing down, and B, because there's a lot of debt coming back into the system to be refinanced, viz here. And that's what the red lines are showing. Now, with that...
Sorry to interrupt, just a super quick question. given the fact that the bubble blown this time was the biggest in the data series, do you expect a correlating largest amount of refinancing tensions to ensue?
Well, the answer would be naturally yes, unless the policymakers are alert to it and they respond by adding more liquidity, which in my view, they'll have to. But it's a question of learning by doing. So they're going to make mistakes en route, which is why I think that if you start to see an inflection in liquidity, we've got to be cautious. But then, I must admit that I was pleasantly surprised by the alacrity and the size by which the Federal Reserve addressed the repo crisis in the US in the last few weeks. Whereas I thought it would take some time to get there, they seem to have got there and they've actually done it in decent size. So, one has to say that maybe they're adapting to events. But generally speaking, we're looking at the world here. Are other policymakers, particularly those in Europe, really as adept as the Federal Reserve? I don't know. I think that's an open question we may have to see. Now, with this chart in mind and this relationship, let's go back to Asia and look at the problems in Asia. Now, here you see the debt liquidity ratios for Japan and China. Don't worry about the percentage levels. That's not important because that really reflects the maturity structure of debt in each economy. But look more about the current levels relative to history. And if you look at Japan, which is the black line, what happened in Japan is the debt liquidity ratio in Japan rocketed higher, as you can see on that left-hand scale, from about 100% to about 300%. So there was a tripling in the debt liquidity ratio. Now, we might say that what is a decent level for Japan, maybe it's certainly not 300, maybe it's 150 or thereabouts they could cope with. But basically what you've got is a problem of a too high debt liquidity ratio, which is strangling the Japanese economy and causing a lot of problems, the lost decades, as we know. What Japan has done in the last 10 to 15 years is address that through the policy of Abenomics, which has recently been continued by the new prime minister. And what they've done is they've tried to monetize debt. If you've got a debt liquidity ratio that's too high, you can get it down in two ways. You can default your debt. That's impossible because debt is collateral for the banking system. Or what you can do is print more liquidity. And the route, spoiler alert, the route that everybody takes is they print more liquidity. And that's monetary inflation. Look at China, and you've got an almost exact copy of the Japanese chart, but 15 years later, 10, 15 years later. And China is struggling under this debt burden. And that debt burden is clearly big. It's strangling the economy. And China is having to get out of that by basically monetizing debt. Now, you could equally say that the US had a similar problem, maybe not to the same extent, with the real estate problems at the time of the GFC. What did the US Treasury and Fed do at the time? They printed huge amounts of liquidity and they got out of the problem very, very quickly. But it did take a weaker dollar and a lot of financial market, a lot of bubble creation, if you like, in financial markets. But China has got to do the same thing. Japan has done the same thing. This is the solution. And if you look at this chart, it's showing net liquidity injections by China. And it's hard to read or to measure the Chinese financial system because there's a lot of different pockets where liquidity can come from. But we think we get most of those. And what this is showing is the year-on-year change. This is actually daily data, but we basically illustrate the year-on-year changes in Chinese liquidity injections. This goes back to 2020. And you can see China didn't do anything during the COVID crisis, particularly, unlike other central banks. But what it's been doing more recently, particularly from late 2024 onwards, is injecting a lot of liquidity in markets. Now, what China has done effectively is over the last 12 months, it's injected between 7 to 8 trillion yuan into their financial markets. That's just shy of $1.1 trillion. In my view, they've got to do at least the same again this year. So I think this is going to continue. And therefore, I'm encouraged to see, this thing clearly cycles, that latest uptick. So it looks as if they're pushing more liquidity into markets. And that clearly is a good thing. Now, what is the evidence elsewhere that they're doing that? And I would cite this piece of evidence. Number one, this is what's happening to the Chinese bond market. So if you start to see a lot of liquidity being pushed into financial markets in China, what you would expect term premia to do, you'd expect term premium to start to rise. In other words, rising liquidity, increasing term premia, increasing bond yields. And that's what we're beginning to see. So tick that box. It looks as if this is a confirming sign. The other thing is looking at the yuan gold price. Now, there's an awful lot going on as regards China's currency, but there's also a lot of, if you like, misunderstanding about what China needs to do. If you were looking at China's trade surplus, you'd have to say, taking your standard economic textbook, that with $1 trillion or in excess of $1 trillion of trade surplus, the yuan, the renminbi, should be revalued higher. Okay, and that's clearly what the consensus view seems to be saying, and all the media are saying China's got to revalue its currency. That's not the answer, because if China revalued its currency, it would just throw it into a pit of debt deflation. It would be the end of the Chinese economy. It would not, in my view, survive that. It would be mass defaults. They can't do that. They actually need the opposite. They want a weaker currency, and that weaker currency is necessary because they've got to devalue debt and they've got to get the paper yuan higher. So in my view, you shouldn't be looking at what may be let's say a manipulated number, which is the yuan US dollar cross rate, because that can be manipulated in a number of ways. You've got capital controls, you've got a lot of intervention potentially by the Chinese authorities, you've got state-owned banks and large Chinese corporations which are probably told to keep those proceeds in dollars and not convert them back into yuan. There may be out of that buying of gold directly rather than investing in US treasuries, all these sorts of things. But the thing to look at is if they're devaluing the yuan by printing money, the yuan gold price is going to go up. Okay. And we said about 18 months ago that what you'd expect to see, you should expect to see if China is going to scratch the surface on debt devaluation, is a yuan gold price of at least 24,000 yuan. And that will be the start. And we've hit that and we've gone up higher. And you can see the chart, the direction of the chart. Now, I don't know where it's going to, but I can extrapolate and I say maybe they're going to at least 35,000. But you get the drift here is if the yuan US dollar cross is not going to change that much for political reasons, but the yuan gold price does change, then you're looking at a significantly higher dollar gold price. And that's why I'd still keep a serious toe in the water when it comes to the bullion market.
Really interesting. Okay. So I was just about to ask you kind of a very general question, which is sort of why should the regular Western investor care about what's going on here with Chinese liquidity? Obviously, it has implications for gold, but I'm sure it's got bigger ones as well. Like China kind of healing itself, obviously, will be supportive of the global economy, I imagine, right?
Yeah, I mean, China needs to heal itself, but China's got serious problems. I mean, I'm skeptical about the ability of the Chinese economy or the current Chinese economic model to actually grow itself or would create decent GDP growth over the next 2 or 3 decades. I think it's very difficult, given the economic policy mix they've got. They've got to do something. They need much deeper and more robust financial institutions. Okay, there's an awful lot of work the Chinese need to do. I think they've been spooked by the threat of stablecoin. And I think that, in financial markets, there's no unrelated events. And I think that, part of the spur for them to actually expand liquidity and try and get the debt problem solved is they see a big threat from stablecoin to the integrity of the Chinese yuan and the Chinese financial system. Because the fact is that, at the moment, the Chinese financial system just does not have the capacity to absorb all this liquidity they're creating through the trade surplus. And they have to rely and lean heavily on the US financial system. And that's clearly from a political point of view, not what they want to do. Now, that will be underscored several times if you've got stable coin because it gives a lot of Chinese exporters a very obvious avenue to go down. And, the alternatives are you either put your money in the Western banking system and risk being sanctioned in the event of some kinetic engagement or whatever it may be, or you put it back into the domestic financial system and you get sanctioned or whatever by the PRC. So
Right.
you're damned if you do and you're damned if you don't. So holding the stable coin seems to be a pretty obvious thing. And I'm sure the Chinese authorities are spooked by the idea that they may be losing even greater control over their financial markets.
And do they have, does the Chinese government have any means to try to staunch the flow of liquidity in China, domestic liquidity into stablecoins?
Far as I know, not. I mean, they're, to the extent that this is in the hands of the state-owned banks or state-owned corporations, they can clearly have some control. But I don't think so. Um, they may try, but if those dollars are offshore, there may be a certain amount of agency on the part of Chinese private companies to actually stock up on stable coin. I wouldn't be surprised. That's what I'd be doing.
Okay, so in your mind, it is a real threat to them.
I think it's a serious threat. Yeah, I think this is what has it actually spurred them into action. In fact.
All right. Well, look, Michael, we're coming up on the hour here. This is, as always, just super, not only information dense and insight rich, but just super fascinating. Is there anything that's really burning brightly on your radar that I just haven't been smart enough to ask you about yet?
I think we've covered pretty much everything, but I'd say that the point that we're really making is that number one, you've got an inflection in the global liquidity cycle. Likely, it may have happened or it's about to happen, but we're pretty much there. The markets are reflecting that because commodities typically perform strongly at the peak, and they're doing that. Equities, I would argue, are sort of laboring a bit, and the early cycle equity areas are becoming more volatile, particularly things like technology. Later cycle areas are beginning to hold to get momentum. So that's all corroborating that fact. What this is being driven by is not Fed tightening or central bank tightening. It's really a redirection of the hose away from financial markets towards the real economy. So this Treasury QE idea is becoming real. That is driving the real economy stronger. China is doing much the same thing, and the PBOC matters more to the world real economy than really to Chinese financial markets. So that's going to, I think, underpin commodities. So generally speaking, I think you've got a stronger world economy this year. And if that's the case and financial markets get squeezed, then you've got an environment where I think lends itself to these contrarian views, which says you probably are looking at a yield curve flattening at some stage through the year, later this year. And you're also looking at potentially a stronger dollar, or at least a firm dollar, and not the weak dollar that many people, continue to project. So I think that we're out of consensus or in a small minority, but that's because we look at different things. One of those being liquidity.
Well, you make a super compelling case for those arguments. I guess the only other thing I just will ask you to help me clarify here is, given all that, it sounds like a message for the average investor here is, if we are indeed going through a down cycle in liquidity, there is a certain amount of pain that one would expect to be taken in the financial markets during that down cycle. And on average, that pain is spread over around 3 years. So kind of mentally gird yourself that it could be that long of a not fun time in the markets. Now, it could be a lot shorter, but the trade-off there is it's more violent and more painful. So
Correct.
just again, as an investor who's had a really good time over the past 3 years, 20+% returns more or less for the past 3 years in a row, you would say, hey, don't expect that for the next 3 years.
Yeah, that would be my view. I mean, I'm not going to put my neck on say out and say 3 years, but I think for the foreseeable future, I'd be cautious. And I also stress that I'm not always bearish. I'm in fact far from it. I mean, we've been very bullish since late 2022. Urging people to get into markets despite similar sort of contrarian feelings elsewhere.
And you
But
were really at that point, sorry to interrupt, but I mean, you were really early and really in a minority then, and you were really, really right.
Right. Well, that's gratifying to hear. Yeah. And I think now we may be wrong, of course. I mean, as I say never. But we've got to follow our methodology, and our methodology is saying that there is a cycle, and that cycle may be losing momentum right now.
All right. Well, look, again, what I really appreciate about your work, Michael, is not only is it sort of, educating and helping us track what you think is the true reality of what's going on, but it's very prescriptive. You've got those asset charts that you showed earlier about what to hold at each phase and whatnot. And so, to your point, you can be optimistic because your framework basically gives us a play in every cycle of the every part of the cycle here of the liquidity cycle.
Yeah, it's a cycle. And I think, if you come back to investing, bull markets are about trends and themes, and bear markets are about cycles. And we've got to be cognizant of that cyclical downturn.
All right. Well, look, Michael, can't thank you enough. Most important question for folks who would like to follow you and your work before your next appearance here on Thoughtful Money, where should they go?
Well, I think the easiest way is to look at our Substack, which is called Capital Wars. I mean, we write a number of pieces every week about what's developments in markets and provide some data. There's an institutional service which is basically available either via crossbordercapital.com or glindexes.com. That's the new rebranding, as you kindly pointed out. And there's a lot of data available to people through API feeds or Excel or whatever form you want. But very data intensive.
All right. They are all fantastic resources. And as a subscriber to Capital Wars Substack, I cannot recommend it highly enough. So, Michael, when I edit this, I will put up the URLs to those resources that you just mentioned so folks know exactly where to go. Folks, the links will be in the description below this video as well. Again, a reminder, if you want to get access to Michael's charts here, just sign up for our Substack. It's going to be available to the premium members. To do that, just go to thoughtfulmoney.com/newsletter. And if you could please, folks, express your gratitude along with mine for Michael for coming on and just being so generous in all the analysis that he shares with us. Please show him that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you've really been motivated to take action in your own personal portfolio based upon Michael's work here, and you'd like to get some professional help in trying to figure out how to position for the different types of plays in the cycle that Michael has shared here. If you don't already have a good professional financial advisor advising you on how to do that, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel every week. To schedule one of those consultations, as a reminder, they're totally free. Just go fill out the very short form at thoughtfulmoney.com. And these, as I said, these are totally free. There's no commitment involved here. It's just a service these firms offer to help as many people as they can. Michael, I can't thank you enough. I'll give you the last word here. As we head into 2026, which again, as we just said, might be a different kind of year than what folks have been used to for the past 3 years. Do you have any kind of parting bits of advice for the average investor who's watching this video?
I just say, watch the cycle. It's going to be, strong economy, potentially weaker financial markets. And that's the difference from what we've seen for the last 2 years.
All right. Well, thanks for being so clear and so direct, Michael. It's so appreciated. Again, I just so value you coming on this channel and your partnership here. Best of luck in what I think is going to be a very interesting year.
Great. Thank you, Adam. Same to you.
Thanks. And everybody else, thanks so much for watching.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to do to gold. It's going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fed coin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at this, all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you want to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? You might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with FedCoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single Fed coin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the Fed coin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? Is there some eerie similarities, like a sort of like a modern day computerized FDR scenario? Okay. Yeah. And so I think when people start seeing this, they start seeing wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, first step is you just need to see things for, you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for Fedcoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. Society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with Fedcoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the Fedcoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax. And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid when we learned about algebra, I was like, what's the point of algebra? And, my father was really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for Fedcoin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the US is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So like that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually I do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that because there's no stopping where it's going. And the world definitely keeps going. And you can survive and thrive through change. 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. And you got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. Yeah. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double, and like you can't even find all the stuff. I mean, it's like I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash because I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting and it goes up, and yeah. I just think that, to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
So you're seeing retail catching the wave, which is driven by governments buying gold, right? So they have to get out of the way of the price. The price is running. Now silver's running. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
China's saying, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce, that tiny little fleck of gold. And silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply. But silver, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, or whatever counted for banking. Actually put it in a bank, literally, bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay, right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks would go, hey, gold's going on a run. We're short that. We're short that. We're short that. Oh, yeah. We manipulate the price. And retail will go, oh, no, I'm losing money. I'll sell. Oh, I'll take it
Right.
back. I'll take it back. And
Right.
you can,
Right.
and the institutions can do that with retail because retail is, there's always the frothy part of retail that is easily manipulated, but they
Right.
can't do that to government. That's, that's playing, that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to his children, stop playing computer games, start getting fit, stop learning English, hey Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, we'll be your friends, we'll make your plastic junk, we'll make money, and we'll all be very civilized and nice, and we can all be friends. But Xi has taken a China exceptionalist point of view, in the same way as America takes an American exceptionalist point of view.
Right.
And in fact, the world needs to be more like the Europeans, who up until recently have been quite laid back. We can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore, or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have your rare earth. No. We've weaponized it. No. See how far you're going to get with your business without our rare earth. Oh, cobalt. No. So now countries basically have to build up strategic reserves of all sorts of critical things. And silver is good. You start by going, the only thing we need is gold, because gold, that's bullets, and we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it, and they say, no, if the ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also that is, I I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you? Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III.
Right.
Oh, oops, I can't build ships. Oh, well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, steel. Oh, no, and I haven't got any I've got no rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm, and Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough. I won't care that there's World War III started. But maybe I'll make so much money. I'll be in Chile. I'm drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to secure myself and my family. And that's how I look at it. It's, I can't. Maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's Russia versus America all over again. Maybe it isn't. Whatever. But if you don't realize what appears to be going on, you don't track it. And you don't, something that is, I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad. Because in a global conflict, it's China, India, Russia, and America, and Europe, right? India is a major player. Now, they historically go, nothing to do with us. No. Nothing to do with us. Nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. Right? China is 1.n billion with all the tech that we love. I mean, forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. Wow. It's like 1/18 of the economic power of Europe, without even factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think, JFK versus Shanghai Airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.
We've not only taken out the big problem that we had with silver at 3,300. There was such strong technical resistance. There was also technical resistance at about 35, but it just sailed through there. And we'll go back to a daily chart so we can get a better idea of what we're looking at. $40 is our next anticipated level. We could encounter resistance. I'm not really expecting any real resistance there. Our studies right now are looking for $42 on the upside, and it is based upon not a daily, but rather a monthly. And so that's the thing. You can, as I said, we've got to go way far back, really compress this chart before we see the last time. Silver seems to have locked on, but the last time was 2014.
Silver has broken above the long-standing $35 resistance, reaching levels not seen in over a decade due to tight supply and strong industrial demand from sectors like solar and electrification. Prices have climbed near $39 to $40, with analysts targeting $42 next and the potential for $45 by 2026. Institutional forecasts by Bank of America, Citigroup, Saxo Bank, and others also converge on a silver price around $40 by late 2025 or early 2026. Gary Wagner, a seasoned technical analyst and the host of the Gold Forecast, explains that silver has recently surged past significant resistance levels, reaching its highest point in over 13 years. This upward momentum is attributed to a combination of factors, including strong industrial demand, particularly in renewable energy sectors like solar and electric vehicles, and a persistent supply deficit. As of August 30, 2025, silver is trading near $37.95 per ounce. Silver has been trailing gold but is now starting to catch up with impressive momentum. However, gold has built strong momentum, rising from 2,300 in March 2024 to over 3,500 before consolidating into a symmetrical triangle. This pattern often leads to breakouts in the prevailing trend, which remains bullish. After pulling back to the lower channel, traders went long near 3,410. A close above 3,473 would confirm the breakout, opening the door for a new leg higher. Despite recent gains, the setup points to more upside ahead. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Lagging behind gold, obviously. Yeah. This, of course, is a daily. And what I was looking at, and I'll flash it back, was a monthly. So you can see the performance this month from 37.48 up to 39.72. Quite a move. 2.42%. $2.42, up 6.5% over the month. And the thing is that this red line was drawn in yesterday because that's where silver had closed yesterday. And so we have not seen these prices really since February 2013. It's definitely the bullseye target right now. Could it go higher? Yes. Yeah. It is reacting in a much more sensitive manner to follow gold, which it was not And now we're seeing it play catch up, so to speak. So I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there, 42.30. And that's the first target. If it breaks strongly through there, 44 would be the next upside target above that. A daily Japanese candlestick chart. And of course, I'm using a combination of studies, but basically trend analysis, Elliott wave, and pattern recognition, such as this symmetrical triangle that we're witnessing. And what we notice is we've had a runaway bull market. If we move it back a little bit, you can see that as you know, we're sitting at 2,300 in March of 2024. Not too much to move it to 3,200, 3,400. So we've got 1,000. And then it runs up to the all-time record intraday high, well above 3,500. Viewers, I am looking at a futures chart, so the numbers will be a little bit different than spot. And then we knew, at least our model predicted, we were headed for a correction, and that's what I thought we would see. But typically in a correction, you get something like an A, a B, and then a C, and then you go back to the motive phase, a 5 count of bullish waves 1, 3, and 5. In between, you get corrective waves 2 and 4. But what happened was when we saw the market go up and hit this top, we had already drawn in the compression triangle and come down. We realized that this was not unfolding as a simple ABC, but something a little bit more complex. This is simply called a symmetrical triangle. The idea behind the symmetrical triangle, of course, is you're going to have a series of rallies followed by a series of shallow corrections, shallow rallies, until you typically get to the E wave. Following the E wave, as the model predicts, and not so well this time, you get what's called a thrust. A thrust is simply when prices break above, that's the wrong one, but is simply when prices break above the resistance line and you get that hardcore breakout. We certainly didn't see that. And so we watched gold go back into the channel. Let me just kind of blow this up a little bit. Go back into the channel and trade back down to the lower end of the channel. At this point, we realized since it did not occur here, meaning a thrust or a breakout, this would be, if it's going to do it at all, this would be the time. This is when we got our subscribers long at about 34.10. We had enough confidence that it's probably not going to break to the downside because, Jeremy, a symmetrical triangle doesn't necessitate a breakout to the upside or the downside. Either can happen. Typically, we see it go to the prevalent trend direction, which of course is higher, and that's exactly what we saw. Now, today, we're right at the resistance line. I hope our viewers can see it. I'll blow it up a little bit more, but as you can see, we've just gone over that a little bit. And so this was the breakout that I have been waiting for. And I believe that a solid close above, let's call it 34.73, will signal that we are going to see a strong breakout to the upside, moving gold substantially higher, even though it's already traveled from 33.58 to 34.78. So it's gone a significant amount, but we think that there's a lot more room to the upside right now. As long as we get an effective close above this resistance line, which it clearly looks as though that's a highly probable outcome.
Gary highlights that the US dollar index is exhibiting a notably bearish technical outlook, influenced by its performance relative to key moving averages. Recently, the dollar has fallen below both the 50-day and 200-day moving averages, signaling a weakening trend. The 50-day moving average, currently around 98.1, is acting as immediate support, while the 200-day moving average, positioned at approximately 102.7, remains well above current prices. Additionally, the 50-day moving average has crossed below the 200-day moving average, forming a death cross, a classic bearish signal in technical analysis. Gary thinks that this alignment suggests a shift toward more bearish market sentiment. Furthermore, the relative strength index is hovering near neutral levels, around 50, indicating a lack of strong momentum in either direction. Covering all the scenarios, we can say that the US dollar is currently facing significant technical headwinds, with both short-term and long-term moving averages indicating a bearish trend. Traders and investors should remain cautious, monitoring for potential further declines if the dollar fails to reclaim key support levels.
This is our simple 50-day moving average, and that's what we would look at for short-term market expectations. If it's above the 50-day on a short-term basis, we are in a solid bullish demeanor. The 100-day is intermediate, and then the long-term is the 200-day. And so I've highlighted the 200-day is in red. Green is the 50-day. It melted through the 50-day, came down and melted. You see how exaggerated the moves were on the days when it broke through the 50 as well as the 200. And so that's significant, because what that tells us is that on a technical basis, on a very long-term basis, the dollar's extremely bearish and has more room to the downside. In terms of targets, if it continues to drop 95, I'm basing that on a Fibonacci retracement data set that beginning of May at 89, up to the record top that we've seen recently at 114. And then the important numbers are drawn in. This is the 78% retracement. This, of course, is our starting point. As you can see, this is the 38. This is the 50. And the fact of the matter is, we're probably close to the, we've even broken through the 61. And in terms of corrections, 61 is a very deep correction, but acceptable. 78 is acceptable, but actually fairly rare. And a break below 78 would mean that we're not looking at a simple correction, but a flip from a corrective expression in a bullish market to a fully bearish market. If we broke below 78, that would signal that. You notice also, when you look at this chart, the 61.8, it comes down, it tests this area, it pops back up, and look, it finds resistance at the 50%. Then it comes back down, breaks through it, and you can see all of the attempts that came in. Let's go ahead and widen this. All the attempts that came in to break back above that, and all of them were unsuccessful. And because of that, that tells me the dollar absolutely has a higher probability of going down than going up.
Yeah.
And the next target, as I said, would be about 95 on the dollar index.
Silver is showing strong bullish momentum, breaking key resistance levels and catching up with gold, while gold itself remains in a bullish breakout setup. Conversely, the US dollar is under technical pressure, with long-term and short-term indicators pointing toward further weakness. These dynamics suggest a favorable environment for precious metals, though investors should remain vigilant to potential market corrections and shifts in momentum. How might the dollar's ongoing weakness impact silver and gold prices in the coming months? What are the key levels investors should watch for to confirm continued bullish momentum in silver and gold? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.